What if I told you that a breakthrough happening thousands of miles away in China could quietly create the next generation of stock market winners? While most investors are focused on headlines, smart money is already moving toward companies positioned to benefit from China's latest technological and economic advances. Some stocks have already started climbing, while others may still be flying under the radar. In today's video, we'll uncover how China's game-changing breakthrough is reshaping global markets, which sectors stand to benefit the most, and what investors need to know before the crowd catches on. Stay with me, because one of these opportunities could completely change the way you look at investing. When most people think about stock market opportunities, they usually focus on what's happening in their own country. They watch domestic headlines, listen to local analysts, and follow companies they already know. But some of the biggest investment opportunities in history have emerged from developments that many investors initially ignored. That's why what we're seeing in China right now deserves our attention. Over the last few decades, China has transformed itself from a manufacturing powerhouse into one of the world's leading centers of innovation. This isn't the same China that investors were discussing 20 or 30 years ago. Today, it is competing at the highest levels in advanced technology, artificial intelligence, electric vehicles, renewable energy, robotics, and next-generation manufacturing. The pace of development has been remarkable, and each new breakthrough has the potential to reshape entire industries around the world. History teaches us an important lesson. Whenever a major technological breakthrough occurs, wealth doesn't just get created for the innovators. It often creates ripple effects that spread across supply chains, supporting industries, infrastructure providers, and countless businesses connected to the trend. Think about the rise of the internet. The biggest winners weren't only the companies that built websites. The opportunity extended to software developers, hardware manufacturers, telecommunications providers, semiconductor companies, and many others. One innovation sparked growth across multiple sectors. The same principle applies today. When a country as influential as China achieves a significant breakthrough, global markets pay attention. Investors understand that innovation changes the competitive landscape. It influences consumer behavior, business investment, government policy, and international trade. In many cases, it creates entirely new markets that didn't exist before. What makes this particular moment so interesting is the scale involved. China isn't simply introducing a new product or launching another startup. It has built an ecosystem capable of accelerating innovation across multiple industries simultaneously. The combination of research investment, manufacturing capacity, technological expertise, and market demand creates conditions that can rapidly transform an idea into a commercial success. This is one reason institutional investors monitor developments in China so closely. They understand that markets often react long before the average investor notices what's happening. By the time a breakthrough becomes front-page news everywhere, much of the early opportunity may already be reflected in stock prices. Smart investors are constantly searching for signals that indicate where the next wave of growth might emerge. And here's something many people overlook. Stock markets don't move based on current reality alone. They move based on expectations about the future. Investors are always trying to answer one question: what will the world look like 5 or 10 years from now? When a breakthrough suggests that an industry could grow faster than previously expected, capital begins flowing toward the companies positioned to benefit. That's why innovation matters so much in investing. Every major market leader we know today was once viewed as a risky newcomer. Every transformative technology was once dismissed by skeptics. Yet time and again, the companies that successfully harness innovation become some of the biggest wealth creators in market history. Of course, not every breakthrough leads to lasting success. Some trends fade away. Some companies fail to execute. That's why investors must look beyond the headlines and understand the broader economic impact. The goal isn't to chase excitement. The goal is to recognize meaningful changes that have the potential to generate sustainable growth over many years. What we're witnessing today is more than a technological story. It's an economic story, it's an investment story. And perhaps most importantly, it's a story about identifying opportunities before they become obvious to everyone else. The investors who consistently achieve extraordinary results are often those who recognize transformative trends early, stay focused on the long-term picture, and position themselves ahead of the crowd. And that brings us to the next question. If China's breakthrough is creating such a powerful shift, which industries stand to benefit the most? Now that we've established why China's breakthrough matters and why global investors are paying attention, the next logical question becomes, Where is the money likely to flow? Because whenever a major innovation emerges, the opportunity rarely stays confined to a single company. Instead, entire industries begin to benefit, creating multiple pathways for growth and investment returns. One of the first sectors investors immediately look toward is the semiconductor industry. Semiconductors are often called the brains of modern technology, and for good reason. Nearly every advanced device we use today depends on chips. Smartphones, electric vehicles, artificial intelligence systems, data centers, industrial robots, and even household appliances rely on increasingly sophisticated semiconductor technology. As innovation accelerates, demand for powerful and efficient chips rises right alongside it. This creates opportunities not only for chip manufacturers themselves, but also for the companies supplying equipment, materials, and software that make advanced semiconductor production possible. Many investors focus only on the headline companies, but some of the biggest winners throughout history have been the businesses operating behind the scenes, providing essential tools and infrastructure that enable entire industries to grow. Another sector drawing significant attention is artificial intelligence. AI is no longer a futuristic concept. It is rapidly becoming integrated into business operations, healthcare systems, financial services, manufacturing processes, transportation networks, and consumer products. As China's technological capabilities continue to expand, AI adoption is likely to accelerate even further. What's particularly interesting about AI is that it creates a cycle of demand. More advanced systems require greater computing power. Greater computing power requires more chips, more data centers, more energy, and more supporting technologies. Each layer creates additional investment opportunities. This is why many investors see AI not as a single trend, but as a broad ecosystem capable of driving growth across multiple sectors simultaneously. Then there is the electric vehicle industry, which has become one of the most closely watched areas of global innovation. The shift toward cleaner transportation has transformed the automotive sector. Electric vehicles are no longer niche products. They are becoming mainstream, supported by technological improvements, government policies, and changing consumer preferences. China has established itself as a major force within this space, influencing everything from vehicle manufacturing to battery production and raw material processing. As demand for electric vehicles grows, opportunities extend far beyond the automakers themselves. Battery manufacturers, charging infrastructure providers, software developers, and suppliers of critical materials all become part of the broader growth story. This brings us to another important area: energy storage and battery technology. Many people focus on the vehicles, but batteries are often the real foundation of the electric revolution. Better batteries mean longer driving ranges, faster charging times, lower costs, and improved performance. These advancements have implications not only for transportation, but also for renewable energy systems and power grid modernization. Speaking of renewable energy, this sector represents another powerful beneficiary of technological breakthroughs. Around the world, governments and corporations are investing billions into cleaner energy solutions. Solar power, wind energy, energy storage systems, and smart grid technologies continue attracting substantial capital. Innovation in these areas can significantly reduce costs while improving efficiency, making renewable energy increasingly competitive with traditional sources. What makes renewable energy particularly compelling is its long-term nature. This isn't a trend expected to last a few quarters or even a few years. It represents a decades-long transformation in how the world generates and consumes energy. Investors who recognize these structural shifts often focus less on short-term market noise and more on the long-term direction of the industry. Another industry worth paying attention to is advanced manufacturing and automation. As labor costs rise and competition intensifies, companies increasingly turn to automation to improve efficiency and productivity. Robotics, intelligent manufacturing systems, and automated production technologies are becoming critical components of modern industrial operations. China's investments in these areas have the potential to influence global supply chains, making automation-related businesses important players in the next phase of industrial development. Companies providing robotic systems, industrial software, sensors, and precision equipment may all benefit as manufacturers seek greater efficiency and competitiveness. The key lesson here is that innovation rarely creates just one winner. It creates networks of winners. When a major breakthrough occurs, investors who focus only on the most obvious company may miss the broader opportunity. Capital often spreads throughout entire ecosystems, rewarding businesses that provide critical technologies, infrastructure, services, and support. Understanding these interconnected industries allows investors to think beyond headlines and identify where long-term growth may emerge. Because in investing, the biggest opportunities are often found not only in the breakthrough itself, but in the industries empowered by it. And that leads us directly to the next challenge: identifying the specific stocks that investors are watching most closely as this trend continues to unfold. Now that we've explored the industries most likely to benefit from China's breakthrough, it's time to focus on the question every investor eventually asks: which stocks could potentially emerge as the biggest winners? This is where many people make a critical mistake. They assume that successful investing is simply about finding the hottest stock and buying it before everyone else. But experienced investors understand that identifying winning stocks requires much more than chasing headlines or following social media trends. The real goal is to recognize businesses that are positioned to benefit from long-term changes in the economy while maintaining the financial strength needed to capitalize on those opportunities. When institutional investors evaluate potential winners, they typically start by looking at market leaders. These are companies that already have established positions within growing industries. They possess strong balance sheets, proven management teams, significant resources, and competitive advantages that make it difficult for rivals to catch up. When a major breakthrough occurs, these businesses are often among the first to benefit because they already have the infrastructure and expertise needed to scale quickly. However, market leaders are only part of the story. Some investors prefer to focus on emerging growth companies. These businesses may be smaller, less well-known, and potentially riskier, but they can also offer substantial upside if they successfully execute their strategies. Many of today's corporate giants were once small companies operating far below the radar of mainstream investors. The challenge is distinguishing genuine opportunities from businesses that simply generate excitement without delivering results. This is why smart investors spend less time predicting stock prices and more time analyzing business fundamentals. They ask questions such as, is revenue growing consistently? Are profits improving? Does the company have a sustainable competitive advantage? Is management effectively allocating capital? Can the business continue growing even as competition increases? These questions may not sound exciting, but they often separate successful investments from disappointing ones. Behind every great stock market performer is usually a strong business creating real value for customers and shareholders. Another factor investors watch closely is institutional ownership. Large investment firms manage billions of dollars and employ teams of analysts whose job is to research industries, companies, and economic trends. While institutional investors are not always right, their buying activity can provide clues about where professional money managers see future growth potential. When institutions begin building positions in a particular company or sector, it often reflects confidence in the long-term outlook. Their involvement can also increase market visibility and attract additional investors over time. This doesn't mean blindly following institutional money, but it does highlight the importance of understanding where sophisticated investors are directing their attention. It's also important to recognize that not every company within a booming industry becomes a winner. This is one of the most overlooked realities in investing. A sector can experience tremendous growth while many individual businesses struggle or fail altogether. Consider past technological revolutions. During the rise of the internet, hundreds of companies entered the market hoping to capitalize on the trend. Yet only a small percentage became lasting success stories. The same pattern appears throughout investment history. Growth alone is not enough. Companies must execute effectively, manage costs, adapt to changing conditions, and maintain strong competitive positions. This is why investors should focus on quality rather than popularity. A stock receiving constant media attention may already reflect extremely high expectations. If the company fails to meet those expectations, even strong performance can disappoint investors. On the other hand, businesses quietly delivering consistent results sometimes create extraordinary shareholder value over long periods. Patience also plays a crucial role. Many investors expect immediate gains after identifying a promising trend. But the market doesn't always reward good ideas right away. Sometimes it takes years for a company's true potential to become fully recognized. Long-term wealth creation often comes from staying invested through periods of uncertainty, rather than constantly jumping between opportunities. Another lesson worth remembering is that stock prices and business performance are not always identical in the short term. Markets can become emotional. Optimism can push valuations too high, while fear can drive prices lower than fundamentals justify. Successful investors learn to separate temporary market sentiment from long-term business value. That discipline becomes especially important during periods of excitement surrounding major breakthroughs. Whenever innovation captures public attention, speculation inevitably follows. Some stocks rise because of genuine business improvements. Others rise simply because investors hope they will benefit. Understanding the difference is essential. The most successful investors don't ask which stock will double next month. Instead, they ask which companies are building the foundations for long-term growth over the next decade. That shift in perspective changes everything. It encourages research over speculation, patience over emotion, and strategy over impulse. Because ultimately, the stocks that generate the greatest wealth are rarely chosen by accident. They are identified through careful analysis, disciplined thinking, and a willingness to focus on long-term opportunities while others become distracted by short-term noise. And that brings us to the most important question of all. How can investors position themselves to take advantage of these opportunities before the rest of the market fully catches on? At this point, we've established that China's breakthrough has the potential to reshape multiple industries and create significant opportunities across the global economy. But understanding a trend is only half the battle. The next step, and arguably the most important one for investors, is identifying the companies that are most likely to benefit from it. This is where investing becomes both exciting and challenging. Everyone wants to find the next big winner. Everyone wants to discover a stock before it becomes a household name. Yet the reality is that successful investors rarely rely on luck. They rely on a process. They understand that behind every stock symbol is a real business, and the businesses that create the most value over time are usually the ones that generate the greatest returns for shareholders. When professional investors begin evaluating opportunities connected to a major breakthrough, they don't immediately ask which stock has the lowest price or which company is generating the most buzz online. Instead, they focus on identifying businesses that have a clear connection to the long-term trend. They look for companies that are solving important problems, building valuable products, and creating advantages that competitors struggle to replicate. One category investors often focus on is established market leaders. These companies already dominate their industries and possess the resources necessary to capitalize on new opportunities. They typically have strong financial positions, experienced leadership teams, global customer networks, and proven business models. When a transformative trend emerges, these businesses are often able to move quickly because they already have the infrastructure in place. Think about it this way. If a new wave of demand suddenly appears, which company is more likely to benefit immediately? A business with billions of dollars in resources, advanced research capabilities, and established distribution channels, or a company that is still struggling to gain market share? In many cases, the established leaders are positioned to capture a large portion of the growth. However, that's not where the story ends. Some of the most extraordinary gains in stock market history have come from companies that were once considered small or relatively unknown. These emerging businesses often operate in fast-growing niches and have the potential to expand rapidly if their products or services gain widespread adoption. The challenge is that not every small company becomes a success story. For every future market leader, there are dozens of businesses that fail to achieve their goals. That's why investors need to separate excitement from evidence. A compelling narrative alone isn't enough. Investors must evaluate whether a company has the financial strength, competitive advantages, and execution capabilities necessary to turn opportunity into results. This brings us to one of the most important concepts in investing: fundamentals. While headlines may influence stock prices in the short term, long-term performance is usually driven by business fundamentals. Revenue growth, profitability, cash flow, customer demand, and operational efficiency all matter. These factors provide clues about whether a company is genuinely benefiting from a trend or simply being carried by market enthusiasm. Institutional investors understand this principle very well. Large investment firms employ teams of analysts who spend countless hours examining financial statements, industry reports, management strategies, and competitive landscapes. They aren't looking for overnight success stories. They are looking for businesses capable of generating sustainable growth for years into the future. One reason many investors monitor institutional activity is because it can provide valuable insight into where professional money is flowing. When large institutions begin accumulating shares in a company, it often reflects confidence in that company's future prospects. While institutional buying should never be the sole reason to invest, It can serve as an indicator that experienced market participants see potential value. Another factor that separates winning stocks from the rest: adaptability. Markets change, technologies evolve, consumer preferences shift. Companies that succeed over the long term are often those that can adjust to changing conditions while continuing to innovate. They don't simply react to trends, they help shape them. This is particularly important when discussing breakthroughs driven by technology. Innovation creates opportunities, but it also creates competition. New entrants emerge, existing companies adapt, and market dynamics evolve rapidly. Investors who focus solely on today's leaders may overlook tomorrow's challenges. At the same time, investors who chase every new startup may expose themselves to unnecessary risk. Finding the right balance requires careful analysis and patience. It's also worth remembering that stock prices don't always move in a straight line. Even great companies experience setbacks. Economic uncertainty, geopolitical events, supply chain disruptions, and market corrections can create periods of volatility. This is where many investors struggle. They become overly focused on short-term price movements and lose sight of the bigger picture. The most successful investors understand that volatility is often part of the journey. Rather than reacting emotionally to every market fluctuation, they focus on whether the underlying business remains strong. If the long-term thesis remains intact, temporary market noise becomes less important. This perspective is especially valuable during periods of excitement surrounding major breakthroughs. Whenever a transformative trend captures public attention, speculation tends to increase. Some stocks rise because their businesses are genuinely improving. Others rise because investors simply hope they will benefit. Distinguishing between those two situations is one of the most important skills an investor can develop. Ultimately, the goal isn't to find a stock that might surge tomorrow. The goal is to identify companies that are building lasting value, strengthening their competitive positions, and positioning themselves to benefit from powerful long-term trends. Those are the businesses that often become the market leaders of the future, and once you understand how to identify those opportunities, the next step becomes clear. Learning how smart investors position themselves before the crowd recognizes what's happening. After understanding the significance of China's breakthrough, exploring the industries most likely to benefit, and examining the characteristics of the stocks investors are watching closely, we arrive at the most important part of this discussion. The question is no longer whether opportunities exist. The question is how investors can position themselves to take advantage of those opportunities before they become obvious to everyone else. One of the greatest misconceptions in investing is the belief that successful investors possess some kind of secret information. In reality, most long-term investment success comes from recognizing patterns, understanding trends, and maintaining discipline when others become distracted by short-term noise. The investors who consistently outperform are often not the smartest people in the room. They are simply the ones who are willing to think ahead and act with patience. Consider how most market participants behave. They become interested in a trend only after it dominates headlines. They start researching a company after its stock has already surged. They pay attention to an industry after years of growth have already occurred. By that point, a significant portion of the opportunity may already be reflected in market prices. Successful investors operate differently. They focus on emerging trends before they become mainstream. They spend time studying technological developments, industry shifts, and economic changes that could influence future growth. They understand that markets are forward-looking. Stock prices don't simply reflect where companies are today. They reflect expectations about where those companies may be tomorrow. This is why identifying long-term trends is so important. A breakthrough may generate excitement for a few weeks or months, but lasting investment opportunities are usually built around trends that can continue developing for years. The challenge is distinguishing between genuine transformation and temporary hype. History provides countless examples of this distinction. Every decade introduces new ideas that capture public attention. Some become revolutionary forces that reshape entire industries. Others fade away once the initial excitement disappears. Investors who succeed over the long term learn to ask a simple question. Is this trend solving a real problem and creating lasting value? If the answer is yes, then the opportunity may be worth serious consideration. If the answer is no, then caution is often warranted, regardless of how popular the story may seem. Another important principle is diversification. Whenever investors become excited about a breakthrough, there is a temptation to concentrate all of their attention on a single stock or sector. While this approach may occasionally generate large gains, it can also expose investors to significant risk. No matter how promising an opportunity appears, uncertainty always exists. Markets are influenced by economic conditions, competitive pressures, regulatory changes, and unexpected events. Diversification helps reduce the impact of being wrong about any single investment. Instead of trying to predict one perfect winner, smart investors often build exposure across multiple companies and industries connected to a broader trend. This approach recognizes an important reality. Identifying the exact winner in advance is often difficult. However, identifying the direction of a major trend can be much easier. By focusing on the broader opportunity rather than a single prediction, investors increase their chances of benefiting from long-term growth. Risk management is equally important. One of the reasons many investors fail to achieve their goals is because they allow emotions to influence their decisions. Fear causes them to sell when markets decline. Greed encourages them to chase investments after prices have already risen dramatically. Both reactions can be costly. The market has a way of testing patience. There will always be periods of uncertainty. There will always be headlines suggesting that everything is either wonderful or terrible. Successful investors learn to filter out much of this noise. They remain focused on their research, their strategy, and their long-term objectives. This discipline becomes especially valuable when breakthroughs generate excitement. During periods of optimism, it is easy to believe that prices can only move higher. Yet even the strongest trends experience setbacks. Temporary pullbacks, corrections, and periods of volatility are normal parts of investing. Rather than viewing these moments as reasons to panic, experienced investors often see them as opportunities to reassess their convictions. Has the long-term thesis changed? Has the company's competitive position weakened? Has the industry outlook deteriorated? If the answer is no, then short-term fluctuations may matter far less than many people assume. Perhaps the most powerful advantage any investor can develop is patience. Wealth creation rarely happens overnight. The greatest investment stories are often measured in years, not weeks. Many of the companies that generated extraordinary returns spent long periods growing quietly before attracting widespread attention. This is why investing should never be viewed as a race. It is a process of identifying opportunities, managing risk, remaining disciplined, and allowing time to work in your favor. The investors who understand this principle are often the ones who benefit most when transformative trends reshape the world. China's breakthrough may prove to be one of those transformative moments. It may influence industries, technologies, and markets in ways that are still unfolding today. While no one can predict the future with certainty, investors who focus on long-term trends, maintain discipline, and position themselves thoughtfully are often best prepared for whatever opportunities emerge next. Because in the end, the biggest rewards rarely go to those who follow the crowd. They go to those who recognize the future before the crowd sees it. As we come to the end of this discussion, one thing should be clear. China's breakthrough is about far more than a single headline or a short-term market reaction. It represents a powerful reminder of how quickly the world can change when innovation, technology, and economic ambition come together. Throughout history, transformative breakthroughs have created new industries, disrupted old ones, and generated extraordinary opportunities for investors who recognize their significance early. We've explored why this development matters on a global scale, how it could reshape key industries such as semiconductors, artificial intelligence, electric vehicles, renewable energy, and advanced manufacturing, and why certain companies may be uniquely positioned to benefit from these shifts. More importantly, we've discussed the mindset that separates successful investors from the crowd, the ability to focus on long-term trends rather than short-term noise. The truth is, the stock market has always rewarded those who are willing to think ahead. The greatest investment opportunities rarely look obvious in the beginning. They often appear uncertain, misunderstood, or even risky. Yet time and time again, those who take the time to understand major changes before they become mainstream are the ones who position themselves for the greatest rewards. That doesn't mean chasing every exciting headline or investing based on emotion. It means staying informed, doing your research, managing risk wisely, and maintaining the patience to let long-term trends play out. Because wealth is rarely built in a day, a week, or even a year. It is built by consistently making thoughtful decisions and allowing time to work in your favor. Right now, the world is watching a new chapter of technological and economic transformation unfold. Some people will view it as just another news story. Others will see it as an opportunity to learn, adapt, and prepare for the future. The difference between those two perspectives can have a profound impact on investment outcomes over the years ahead. The future doesn't belong to those who react last. It belongs to those who prepare first. And the investors who recognize tomorrow's opportunities today may ultimately be the ones who benefit the most from the changes shaping our world. Thank you for watching. And remember, the biggest opportunities often appear long before the crowd realizes they exist.